Thank you, everyone, for making time to attend the session today. We know it's after lunch, so we will try and, my panelists will try and be as engaging as possible. So we're talking today about building hedge funds in Asia and how to build a great hedge fund in Asia. Let me first start by providing some context to the discussion. So the hedge fund industry today manages over $2 trillion in assets globally, and Asia accounts for roughly 9% of this, or just under 200 billion of assets. Based on data compiled by Asia Hedge, this is a 16-fold increase from 2000. So there has been a significant growth in hedge fund assets over the past 15 or so years. What's interesting, however, is that this period of growth has been, you can break that down roughly into two distinct periods. So the period from 2000 to 2007, where there was a significant growth in assets and number of hedge funds, both in Asia as well as globally. But then the second half would be the period post-GFC, where you see a big sharp drop-off in asset growth, and then more moderate asset accumulation post that. In fact, at the end of 2014, the amount of hedge fund assets managed in Asia is about the same as it was back in 2007, pre-GFC. So how does this play into the conversation today? So in this environment where we're seeing more moderate growth and more modest growth in hedge fund assets, it has clearly become more challenging for newer hedge funds to raise capital. And it appears that Asian hedge funds have actually had it more difficult than others. Based on data compiled by Eureka Hedge, many Asian hedge funds have failed to survive beyond the first 5 years since inception of the hedge funds. And this proportion is actually greater than that of their North American peers. So what does it take for a talented hedge fund manager to build a business in Asia that can survive and come out stronger in this period? What does it take for Asian hedge funds to stand out and attract capital from investors globally? And what are the key ingredients to building a great hedge fund in Asia? So with us on the panel today, we have a group of people who are eminently qualified to speak on this topic. We have 4 hedge fund managers who will, over the course of the panel, discuss the goals for their firms and their personal experiences building a hedge fund in Asia. So I'm going to start and introduce them briefly. So on my far left, Danny Yong, who is the founder of Diamond Asia. Next to Danny is Nick Taylor, founder of Senrigan Capital. I'm going to skip Manraj for now. And turn to, on my right, Adam Levinson, founder of Graticule Asset Management Asia. And then Haider Ahmad on my extreme right, who is the founder of Broad Peak Management. And Manraj Sekon, who is on this panel because he represents an investor in hedge fund. Fullerton Fund Management offers a range of products, including a fund of hedge fund products. So Manraj would be able to shed light on this topic from the perspective of an investor in hedge funds. So let me begin the panel by first asking, and let's try and define this term, great hedge fund in Asia. So Danny, I'm going to pose the first question to you. What's a great hedge fund, and what does success look like to you in thinking about the firm that you're building?
Thanks, Alvin. I'll tell you in 30 years' time. Because we're in the process of figuring out how to build a great hedge fund in Asia. Clearly, when investors put money into hedge funds, it's about superior risk-adjusted returns. So that's definitely something that has to happen. But on top of that, I think many surveys that have been done by the likes of Cambridge Associates and other custodian banks have shown that institutional investors actually don't rank returns as number one. Maybe in many ways, it's taken as a given that if you put your money in hedge funds, it would produce you the returns that you seek. But quite, or maybe not surprisingly, but the number one factor that comes out a lot is infrastructure, and then number 2 is alignment of interest, and somewhere third or fourth is diversification. So with respect to infrastructure, I think today, as Alvin you mentioned, why is it post GFC? the Asian hedge fund space actually hasn't grown, right? It's gone back to the same size as 2007. In many ways, 10 years ago, when investors first came out to Asia to look for hedge funds, I feel that the requirements, especially on the infrastructure front, wasn't as stringent, where in some ways, Asian hedge funds were given a hall pass in some ways. But today, post the GFC and post Madoff, investors are no longer that forgiving. The standards are, they expect to, in order to be classified as investable, investors expect a global institutional framework on your infrastructure with respect to operations, risk management, and compliance and legal. And on the other point of alignment of interest, I think again, as we seek to build a hedge fund that hopefully will last the test of time, I think the ability and focus on understanding what the investors want and aligning the the entire firm culture towards putting the investor as number one, to me, is extremely crucial. So maybe I'll just give an example for our flagship macro fund. It's like in 2014, our macro fund returned 19%, and we were one of the top performing macro funds. And in January of 2015, due to some unusual and unexpected market moves, we lost 10%. Right? So imagine if you were an investor having to pay fees in 2014 on 19% performance, and then in January we got hit by these unforeseen circumstances, but nevertheless losing 10% for our investors. At that point, we essentially made a decision, myself and our partners, to offer voluntarily a clawback to our investors, right? Which means that we say, we're in it for the long haul. If you believe that you'll be able to make it back, then you should be, willing to put, kind of dip into your pocket and basically give investors back what they paid you last year. Again, very heartening to see that post our offer to our investors, we have actually seen net inflows this year, despite that challenging start to 2015. We've seen net inflows of 500 million from mostly our long-term partners.
Yeah. So I hear superior returns, requirements, more stringent requirements on infrastructure, and demonstration of alignment of interests as some of the key points that you mentioned, Danny. Adam, do these resonate with you? Is there more that you would add to that?
Yeah, they certainly resonate. I think there are a couple things I would add. First, I think philosophically, building a great hedge fund in Asia is no different than building a great hedge fund anywhere else. And so the elements that Danny described, I think, are correct. Alignment of interest being incredibly important, but I also think those are standard elements. Like without them, you have no chance. But with them is not at all a guarantee of anything. I think really to build a great hedge fund, you need first a philosophy and a particular culture of doing things that is not like everybody else. I think that you need to be able to demonstrate process. You need to attract and retain excellent people. And I think you need to invest. Increasingly, my view is these are more and more becoming IP businesses, and they require a fairly large investment in technology. And in my view, in the next 2 to 3 years, that will be much greater as well, because the delivery mode of a hedge fund, in my view, is going to change. It's going to change a lot over the next 3+ years, and that requires a very different type of investment in IT infrastructure than what is sort of typically attendant to a hedge fund. And then the last point I would make is, beyond the standard compliance related related I think you need to voluntarily submit to regulatory oversight in as many jurisdictions really as you can think of, because you're going to run a global business. you're going to operate in various domains and to ensure that you're compliant is really a requirement. I'd leave it at that.
Okay.
I just wanted to add one thing, just to pick up on Adam's point. I think the industry attracts very bright people, and one of the big challenges, and this is to the investment process and the culture, is that you need to kind of teach people to realize that the market is a very humbling place. It's a very efficient place, and we in our organization obsess about, what do we know that the market doesn't? Where is our edge? How do we think about it? Do we really have an edge? Are we fooling ourselves when we think we have an edge? And that, by the way, that whole thing, when you deal with it with very bright people, is a very humbling process for very bright people, because they're very convinced of their views. And so I think, the organization needs to be a humble organization, needs to self-learn constantly. It needs to pick up on its mistakes, and it needs to recognize those mistakes on an ongoing basis. Hey, listen, I made a mistake. Here's what's going on. Here's what we're going to do. Here are the lessons learned. And here's what I'm going to do better the next time around. And that has to be done in a very honest and transparent way.
Yeah.
I think Hyder's right. I would just add one thing. The process of doing that makes the building and development of a hedge fund relentless. I mean, it is, you literally have no free time, because any time that you have that's not spent investing is then spent on cultural issues, on development of people, and then on honest evaluation of yourself, and consistently trying to build out metrics for that.
If I could maybe sort of add on to that, I think the comparison between building a hedge fund in Asia and elsewhere, I think as it was said earlier, is there's no difference in terms of what makes a great, not just hedge fund, but business in one part of the world and another. But it's the ingredients that you have to do it in the place that you're doing it. And so in the US, there's an enormously deep bench of talent. Multiple generations of people who are talented and experienced. That's less true in Europe, and it's even less true in Asia. And partly because of the thing that you mentioned with respect to there being two parts to the growth cycle. A lot of people have not worked at any one place for a particularly long time. Things turn over quite quickly. And as a result of that, also because of there's a difference in cultures in different environments. And so maybe there aren't very many hedge funds that have got very deep cultures. And so that encourages a lot of the individuals that want to work and do work in hedge funds to potentially think a little bit more individually. Naturally, it's an industry where people do think individually to quite a large extent, but to have a business that survives, you've got to have a deep culture. And to have a deep culture, whilst you want individuals who are pushing forwards and are driving things and do care very much about their careers and naturally, therefore, their compensation, you also want people that genuinely work as a team. No good business in the world, in any sector, survives without there being some sort of esprit de corps, some sort of team focus. Because anything can go well when things are going well. You can have a set of people in a room that look like they're a team when performance is good, whatever the underlying business might be. But the moment that things get difficult, you find out if you've really got a team. You find out whether people are saying, instead of, this guy's lost a ton of money and I can't believe it, he's risking our business. Instead of saying that, that could have been me last year, or it might be me next year. How can I help? What can I do? How can we all be pointing in the right direction to keep, I think that's a more difficult thing it's a difficult thing to achieve in any industry, in any business. It's a particularly difficult thing to achieve in Asia.
Hold that thought, Nick. I'm going to follow up on that point later. But, it's interesting. The discussion so far has been about people, about culture. Manraj, in sort of selecting a hedge fund, how do you identify, or how do you cut through all the information that you're given and cut right through to thinking about whether or not this is a team that is or the person, the founder is building a firm that is going to be sustainable and going to thrive long for the future?
Yeah, I don't think there's a simple answer to that. I agree with pretty much most of what's just been said, and a lot of those attributes that the rest of the panelists have been talking about are true for any investment organization, philosophy, persistency of returns, but I think even more so in the hedge fund industry, given the expectations of investors, given the economics, and so on. We've been allocating to external hedge funds over the last 10 years or so. So we've seen the industry develop in the cycles we've seen over the last 10 years. And I think we've seen a number of different phases. The first thing I'd say is the way we approach a hedge fund domiciled in Asia is absolutely no different from a hedge fund in London or New York or anywhere else. The thresholds we put in place for returns, for performance, for risk, for transparency are absolutely no different. And I think the same is true for allocators around the world. So it's no different in Asia. The second thing I say is, over the years, you've seen evolution of the Asian hedge fund space, certainly from our perspective. Perhaps 10, 15 years ago, it was acceptable, appropriate for an Asian hedge fund to be run out of London or New York or elsewhere. And research insights were derived from being out there, and that worked for a while. Increasingly, given what's happened in the world, given what's happened in markets, given the development in Asia, it is absolutely essential for people to be on the ground. So whereas previously we would look at managers elsewhere, now an Asian hedge fund has to be based on the ground. And why do they need to be on the ground? They need to have the networks, they need to have the insights, they need to understand the nuances of what's going on over here, and through that be able to derive original research, original ideas. So I would say we're in a new phase of the Asian hedge fund evolution. But even with that, and I think this is the challenge you refer to, given the world we live in today, and this is a macroeconomic point as well, the risk environment we live in means that even if you're a hedge fund based here, your appreciation of the macroeconomic picture, risks, and how that applies to what you do over here is absolutely essential. So whilst a great hedge fund needs to deliver returns and needs to be able to differentiate themselves within Asia, the one thing I would point to almost more than anything else is the manager's appreciation of risk and understanding of risk. And to your point about the number of managers who have started, appeared to do well, and then fallen by the wayside, many reasons for that. But I think one of the key reasons was an underappreciation of risk. And the last thing I'd say, just following up from Danny's point and one or two others, is the investment in the infrastructure. So when you say great, we talk about returns, we talk about people, we talk about integrity, but it's also the sustainability of the business. And over the life cycle, over market cycles, the opportunities for returns shift. How does a manager evolve his team, evolve his structure, adjust to market conditions? And how does he have the intellectual capital to be able to reinvest to say that he will be able to deliver in different market environments?
Now, we spoke a bit about how it's no different building a great hedge fund in Asia, or it's how you look at a hedge fund in Asia and what's a great hedge fund in Asia. You use the same sort of guideposts, benchmarks to evaluate that compared to their North American and European peers. However, today the Asian hedge fund industry only comprises 9% of the total global hedge fund universe, right? And so it's a reality that most people allocating to hedge funds are still allocating to hedge funds in the West, and in particular North America. Would be interested in views around the panel on why that's the case and what your experiences have been in trying to get capital from where the capital base is, North America and Europe. Adam?
I mean, as somebody who's run a fund both in North America and in Singapore, My answer is pretty self-evident. It shouldn't be a surprise because that's where the money is. When you look at the vast pools of institutional capital, North America is dominant, and even among those of us sitting on this panel, I would argue that the vast proportion of money we all manage comes from U.S. pension and endowment, corporate pensions, state funds, or provincial funds in Canada and so on. And so proximity matters, and it makes it more difficult to raise money from those institutions, if you're in Asia.
Okay, let's maybe sort of move on to talking about some of the early day experiences of running, of starting the fund. I wanted to turn specifically to Nick and Danny in this regard. We were just discussing before that Nick and Danny really started their funds, Danny 1 month before the financial crisis, and Nick a few months after. Would be interested, for you to talk about your experience starting the hedge funds during such a tumultuous period, and looking back, what do you think were some of the things that you've done right, or what might you have done differently, given the experiences that you have today? Maybe start with Danny on this topic.
Sure. Given that we were just before the GFC, and frankly, if we were to have launched after Lehman went under, I'm not sure whether we would have been able to launch. So it's pretty amazing what Nick was able to do after. And yeah, for us, I remember distinctly that we only had one prime broker and only one ISDA when we first started. So this is August of 2008. And then September of 2008 came and Lehman went under. And imagine, trying to get out of your positions during that period as a captive client to only one bank. And so, and I think our first 2 months were extremely rough. Again, thanks to launching into the eye of the storm. We were down 13% after 2 months. But I think the one thing that we did right was that we got the right partner. So, we were seeded by Tudor Investment Corporation, and Tudor fully understood what we did. And the reasons behind our drawdown, and they essentially stuck by our side and allowed us to basically get back to positive returns in a couple of months. But the thing is if we did not have that right partner, I probably would not be sitting here today. I think the second thing was to also put your head down and just focus on returns, right? I think when you first start, there's a lot of distractions between building an infrastructure and especially fundraising and speaking to investors. I think for us, at the early days, we just decided that the best way to sell a fund is to show the returns. So we focused on returns. We kept costs low as well. I mean, we were in a little tiny shop house, 70 square meters, 4 of us. Everything from IKEA, second-hand furniture, and that essentially allowed us to also have less pressure with respect to costs and to focus on returns. And the last thing was. Like what Haida mentioned about adapting. I think after the GFC, the world was a totally different place. And I'd argue that every year or so, we continue to have to evolve because we are really in a very unusual period. And I think thanks in no small part to these unusual monetary policies that are happening around the world. So for us, after the GFC and our initial drawdown, we basically had to, we modified our risk management and came in and instituted a 4% monthly circuit breaker and just says, we are not in a normal world, and I still don't think we are, and therefore you need to have a circuit breaker to ensure that you stay in the game. And that, again, resonated with our investors.
Yeah, when we visit hedge fund managers, we like to see IKEA furniture in their premises. But second-hand, you're right.
I still have the IKEA clock.
I'm just going to turn to Nick now, and maybe have you talk about your own experiences.
Yes, so I mean, I think on at least 2 of those points, I'd 100% echo the criticality of them. I think having the right partner. So we launched in towards the end of 2009. And our original plan was we'll launch with partner capital, we'll run the fund for a year. Clearly, coming out of 2008, raising money for an Asia event-driven fund isn't going to be the easiest thing to do, so let's run, demonstrate a track record, and then raise money. And we were introduced to Blackstone and formed a good rapport with Blackstone, which led to them making a strategic investment in our fund. And I think, at the time, a lot of the people that appear around the launch of a hedge fund, there's many of them who intermediate in many different ways, were of the view, perhaps don't do that, you've got enough to launch on your own, and you're giving something up by doing that naturally. But I think myself and my partners believed that having such a strong institutional partner, giving us more critical mass to start with, and critically, whilst we had a lot of experience managing portfolios, and I had significant experience managing teams of people in Asia, I'd never set up a business before. I'd never thought about, exactly what happens in an ISDA, what type of IT infrastructure should we buy, how does an administrator work, what's best practice here, what's best practice there. And having sort of one of the world's largest fund of funds who know best practice everywhere, be able to help us do that, was, I think, a phenomenal investment for us to make, and a great decision, and one that I've never regretted. So the right partner to be able to see you through difficult times as well as good ones is important. They understand you, they do a lot of work, they believe in and trust the team. And so when choppy waters come about, they've underwritten your business to an extent, and clearly there's lots of conversations, but the support that they gave us through a difficult time that we had in 2012 was enormously valuable, and one that really I doubt we would have survived past the 5-year mark without, and we have, and it's certainly partly to them that I attribute that. I think that Danny makes a really good point about focusing on returns, and that's a really important thing to do. It's also an extraordinarily hard thing to do, particularly given your investors are predominantly in the US. And there's the number of people that at any one point in a day appear that you need to deal with is enormous. So if you have to be trying to do that, but there's no, it isn't possible, I think, to set up a hedge fund and be the CIO of the hedge fund and just push all of that aside. You couldn't say, I'm not going to meet investors. I don't want them to, I'm busy. You've got to spend time with people. You've got to get to them. So there's a balance there that needs to be struck. And I think one of the things that we did, we listened very, very hard to what investors were saying. Now, they'd all come out of 2008, and there were predominantly, lots of people said lots of different things, but there were predominantly two things that investors were really worried about. One was side pockets. So in 2008, lots of funds had used side pockets, and there was a view in 2009 and 10 that perhaps they hadn't necessarily used them for 100% fiduciary reasons. And there was also a focus on concentration. So people had said they were running diversified portfolios, and then when people went to redeem in size at the end of 2008, they found there was much more concentration than they anticipated. So we tailored what we did for the first 2 years very, very, very much to the expectations driven out of the fears of investors because of what had happened in 2008. And I think that if I was asked, what might you do differently? What I might do differently is not tailor a PPM for a fund to be either the lowest common denominator or the highest common factor of all of the sets of fears and hopes of every investor. That's almost an impossible equation to solve, and one that sets up internal conflicts. I think we're past that now, but I think that'd be the one thing that I'd say. It's very, very easy to do when you've had people that have had the experiences that they've had through investing in funds in 2008. To be hard to say, no, we're not going to listen to that, but to create a package of fund features that caters to all of those things, it isn't necessarily the best thing to do.
So you essentially have conviction in what you think is the right solution, and not look to cater to every single investor.
I wouldn't have put it quite like that, but sort of something like that, yeah. So,
I just want to add one other thing to what they said. I totally buy into what they said about the strategic partner. I mean, critical for all of us, including us, the partner, if you have the right partner, can make all the difference in the stability of the business. But I think one of the biggest lessons we learned in '08 was that you need to make sure that all your LPs not only understand your base case business plan and your investment process, but your 5 standard deviation investment process. What's going to happen when the world blows up and how you're going to behave. And you want to make sure that their assets and liabilities are such that they can weather the storm with you in the way you want to weather the storm. And I think the biggest lesson for us was that we had a mix of investors, all different kinds of investors. And I'm not suggesting that one kind of investor is better than the other. I'm not suggesting that at all. I'm saying some people assess your business on a baseline basis and assess your business on a 3 or 5 standard deviation basis. And when you sit with them and say what you're going to do, that's a great exercise, because then there are no, I mean, in that Lehman moment, there are no issues. Otherwise, you've got 15 investors all saying you ought to be doing something different on that very day.
Right.
And that's very dangerous
Right.
for our organizations.
If I could just pick up on that, we talk about alignment of interest. We also focus on alignment of expectations. So fund managers will go through good periods and bad periods. What we expect when there are difficult periods is the level of communication, the level of interaction, the level of explanation and detail is absolutely essential. So obviously you expect people to go through more good periods than bad, but an understanding that the reasons for the negative performance is consistent with the process, with the approach, with the style of the manager. So that ongoing dialogue, that transparency is absolutely essential to build the great relationships that build the great hedge funds.
Right. Haida, I might come back to you and sort of talk about the early days, because your experience of starting a hedge fund was kind of different in that you came from a big organization, Goldman, where you moved into running Broad Peak.
So did Danny and Adam, by the way.
But I guess I wanted to get a sense from your perspective as
Yeah.
to how did you adapt to that kind of situation? What did you find surprising in that kind of environment?
Yeah, so I think the biggest surprise, in all large organizations, I think Goldman's a special place, but all large organizations, I think what you take for granted is how people learn in an organization. So somebody comes inside an investment bank, they go through a training program, they sit on a desk, it's really a large apprentice organization. We all sat next to some people on the desk, we learn from them, we kind of move around.
Yeah.
We learn at the water cooler and various other ways, ongoing programs. And so the firm has a culture, and if it's an organization of 10,000 people and you're a class of 50 coming in, you get subsumed by that culture, you learn it, you pick it up. Mm-hmm. When you start a hedge fund, and I'm sure it's true for all of us, when you hire your first partner or your first person, and if they don't happen to be the guy sitting next to you at Goldman or Deutsche or whatever else, well, they're coming from a different organization with a different mindset. They might be very bright, but communicating with them, assessing different situations with them, our business is all about swinging at the fat pitch, right? Defining what is a fat pitch, what's our hit zone, that's a very complicated process when you come from a different mindset and different organization. They can both be right, but they may not be talking to each other the right way.
Right.
And so I think to us and to me, that was the single biggest surprise in how much I took that process for granted when I was at Goldman. And what a great job many organizations do in kind of inculcating the same values and analytical abilities. So I would say that would be the biggest surprise. The other things are pretty obvious. When you're in a smaller organization, you can be far more nimble than you can be in a big ship, and you have to kind of move the Titanic. The job is a much purer job, so in my mind, there's much greater joy, analytical joy, and I tell everybody I get paid to learn every day. What a great thing! What a great job I have.
Yeah.
Which is very different than in a large organization.
Yeah.
The one thing I think you mentioned that may or may not be apparent to the audience is that your answer to many of Haider's questions, really leads you toward a particular business model as a hedge fund, whether you want to or not, or whether you think about that ex ante or not. And many of the questions you were wrestling with lead you toward a sort of holistic organization, investment team philosophy, whereas if you're really assembling traders, that's much less of an important issue. Then you manage it through a risk management process. And the interesting part about this business is that there are many successful examples across that spectrum, but you need to know who you are and where you fit.
And so, this notion of, having to work with a fresh team, developing your own culture in essence, right, within the organization, attracting, retaining talent. Could you elaborate more a bit about your philosophy to that, Adam? And maybe I'll follow up with Haider on that as well.
I think there are two or three parts that are really important. The identification and attraction of smart, capable people is one thing. That's probably the easiest part. Mm-hmm. Creating a culture is much harder. And then furthermore, developing people, even once you have a culture, developing people within a hedge fund organization, I think is the most difficult. The entities just aren't set up to do that. You have to be worried about returns, and then you have to be worried about the business and your investors. Yeah. And actually developing people ends up being very difficult. And so I think, at least the way we do it is we limit, we know up front there are a limited number of people that we can invest in and truly integrate. Right. And you only have so much bandwidth, so if you acknowledge that up front, you have to be very discerning about the type of person you hire up front and that they're a fit philosophically coming in. Otherwise, you have no chance, in my view. And it's undermining to the culture and the pre-existing relationships.
Haider, do you have different?
Yeah, I mean, I think to me, the solution to this, and I totally agree with Adam on this point. It's a very difficult exercise, but I think that the solution is just being honest and transparent with people up front, and saying, this is the organization we're trying to build. This is your role. This is what we expect from you. And by the way, this is a funny place because you get a daily report card, whether you like it or not. And we may choose to grade you on an annual basis or a 3-year rolling basis or a quarterly basis, whatever the organization is. But you will go home every day with a report card. Yeah. And you'll have to live with that report card a little bit. So you're going to have to make sure people are trained up for that sensation that they will have in the organization.
There's another feature as well which links back in some ways to the title of the panel, which is, I guess, unlike in North America, there's a lot of different cultures here. Both in the countries that you're investing in, the situations that you're investing in, depending upon what the investment product is. It's people that are making decisions about things. It's agencies and governments that are making decisions about things. You've got to be able to read those. But also the team that you have to be able to read them as well. And moving from, I started in Japan, spent an awful lot of time learning about Japan and Japanese before hiring people there. And then when thinking about expanding in the sort of mid-2000s into other countries, it's as was said earlier, finding people that are clever and financially experienced is not the hardest thing. There's a lot of them, and they seek you out. But finding people that have got good judgment and good perception, and let's just say good manners and good ability to work with other people, it's very, very hard to read off a CV. Yeah. And it's even harder to read off a CV if it's in a country if it's somebody from a country or a culture that you're not from. So one of the things that we did was, let's hire people who come from countries that we want to ultimately invest in, but have cultural skills in countries that we already invest in. So the Chinese M&A banker who happens to speak fluent Japanese, who can then come and work on Japanese situations, and you can evaluate their judgment. You sit next to somebody for 6 months, 9 months, a year. You work on lots of things with them, and soon you'll find out whether you can trust them, whether their judgment and perception is good, and then it's easy to say, okay, well, let's look at stuff in China or Korea or wherever it may be. But I think that's a unique, maybe that's true in Western Europe as well, slightly less so, because I think the family resemblance between Western European countries is greater than the family resemblance between the different cultures in Asia. But that's, I think, a challenge here that doesn't exist elsewhere.
True, I agree. I think Asia is very fragmented. Clearly, unlike the US or Japan, is very homogeneous. But investing across Asia, there's so many different nationalities and therefore cultures, right? And at Diamond Asia, we actually have like 21 different nationalities, and putting all these guys together and trying to engender, a culture of collaboration takes a lot of basically constant effort. But I think if you are able to get it, because at the same time also hedge funds very focused on almost like, purely on performance and therefore linking performance to your payout, right? So how do you get the guy to share information and be willing to teach? As Haida mentioned, say at the bank or at Goldman Sachs, you learn through osmosis through the guy that sits on your desk because you're not paid on a precise formula. But in some parts of the hedge fund industry, the portfolio manager is paid on a formula. And how do you incentivize him to essentially help the guy sitting next to him? But I think if you are able to achieve that, and it's actually necessary for success in Asia.
We have a few more minutes on this panel. We'll be interested to see if people in the audience have any questions for our panelists. Yes, gentlemen.
Vikas Garg. I work for a hedge fund here in Singapore. In my prior life, I was working at a pension fund in the US, and I think one of the questions that a lot of institutional investors grapple with when they make that first decision to invest in a hedge fund is they're investing for a very specific strategy. There was an article that John Little from North Hill wrote in the FT a couple of weeks back talking specifically about how investors have to grapple with generally investing in a hedge fund manager, whether it's a credit manager or a long-short equity manager or whatever have you, for a very specific strategy, but then grappling with the issue that that manager wants to grow and do a lot of other things outside of their skill set. And so I just wanted to get your sense on sort of what your thoughts were on that as you sort of evolve, continue to take in assets, grow your business. Do you continue to focus on your core strategy, or do you look to grow by acquiring talent, acquiring people that might be doing other things, and how your investors feel about that? Thank you.
I'll answer that. I think that, to go back to where we started, one of the other elements that I think we failed to mention with respect to building a great hedge fund is you have to have domain expertise. I think that's a given in whatever you're doing. If you don't have that, you won't last. Having said that, as you grow, if you choose to grow outside of that area of domain expertise, in my view, you can't do it yourself. That's really a job of the business, not the CIO, not the existing fund. You can't be in the business of having your existing investors subsidize some foray into a new business. You can go about building a new business, but that really requires a whole separate infrastructure of management talent. And by the way, I would tell you that that is the biggest issue in Asia. I would say there are excellent operational people in Asia. Those with true hedge fund management experience, as in those that are strategic, you can number them on your hands. There are virtually none, and certainly none that are available. So to do that, my view, is a requirement to bring somebody here from the US or Europe. That management expertise does not exist in Asia.
Danny, would you like to answer that question as well from the perspective of what Diamond is trying to do across its platform?
Sure. I think I agree with Adam that if you decide to branch out into other businesses, it has to be run by a separate team that has that distinct track record and expertise. Because it's as we talk about investor communication and the transparency, investors that invested in a macro fund should not be at some point subjected to you investing in, say, some distressed bonds, right? I mean, theoretically, the mandate was broad, but investors are trusting you to do what they first invested in you to do. So for us, as we grow the fund and we develop our relationships, or broaden the relationship with the investors, it's in distinct parts. Right? So I think the parts that we could share in terms of maybe the legal infrastructure or the operations, then there's synergies there. But other respects with, say, our seeding business or the long-short equity program, it's done like by completely different teams, and my partners are running it. So,
if I can just add, we've seen a lot of hedge funds grow in Asia over the years, and there is a correlation in terms of size of hedge fund, obviously, and performance. I think that's a given. And the reality of the markets in Asia means that, again, depending on your definition of a great hedge fund, is a great hedge fund a multi-billion-dollar hedge fund, or is it a very, very high-performing hedge fund? Clearly, one is a function of the other. But given the markets in Asia, we found, understandably, a temptation for managers to go out into new areas, go out into areas outside of their natural domain, try and bring people in to do it. And that's difficult. And often, as we look at the life cycle of a hedge fund, being disciplined enough to say, I'm going to stop here, I'm going to focus, I'm going to consolidate, I'm going to invest in the business, I'm going to take a view over the long term, rather than just grow. I think that's a difficult choice. And that's correlated with some of the failures that Alvin talked about at the beginning.
Okay. Yes, lady in front, please.
Thank you, Maria Cantillon. It's a great panel, and so thrilled to be here in Singapore, actually, to listen to you all speak. So I have a question. So I worry about the growth in Asia. It's 200 billion, levels of 2007. So as I sit here and I think about the sovereigns in the region, and some of them taking their hedge fund management in-house, do you see that growth is going to be taken away from you? And then also I think we've seen the industry grow because of second and third generation hedge funds, especially in the US, and we've seen them in Europe too. So kind of going back to your talent question, is the Asia market going to, how do you think it's going to grow in both terms of AUM and also number of managers, and creating a second and third generation hedge funds?
Maybe I'll have a quick go at that.
Sure.
So if you look at the opportunity set from, let's say, 2000 to now, and how much sort of deployable capital there might be in different areas, and not just from a what's the market cap of a country, but how is liquidity changed, how hedgeable are things, what new instruments are available. There's been an enormous shift, and that shift hasn't taken place necessarily in a linear way. There have been periods of time where new indices or new markets open, or new rules change that allow that. And so I think when I first looked in sort of between 2000 and 2005 at what you might be able to do in non-Japan Asia and event-driven, there was very, very little. Occasionally there'd be a big deal, but most of the time there was very little. That opportunity set has changed. Obviously, with China opening up, the addressable market is very, very significantly better. So the opportunity set is there to run an awful lot more money, and I think an awful lot more money is actually being run, because $200 billion is only money that's run in hedge funds that are set up locally. There's clearly plenty of international funds that are headquartered elsewhere that are feeding money into Asian markets. With respect to the sort of the pinch point, i.e. talent, then that that doesn't necessarily happen in a linear way either. There are it's hard to find a specific person to do a specific thing. And when it's the case, and this is a definitional problem of Asia, when something's hot, everyone wants to do it. There'll be 20 funds from the US hiring headhunters to find somebody to do whatever the hot thing of that moment might be. And that makes finding people very, very difficult. So I think it takes a long time, perhaps even a decade, perhaps even longer, for the relevant experience, not necessarily at sort of running a hedge fund level, although that will clearly happen too, but at the PM, at the senior analyst level, at the to have the depth of experience that's required to populate either bigger funds that run more money, operational leverage notwithstanding, or more and more funds. And that, to the extent that you get growth in excess of that, and it's hard to measure what that is, but you saw that really sort of, let's call it 04 to 07, where, and perhaps you saw that in Europe as well, where you'd see new funds, not necessarily with a lot of infrastructure, the hall pass that was mentioned earlier, or not necessarily with a huge amount of experience, attract enormous amounts of capital. That wasn't sustainable, and I think that a more sustained growth in the industry as experience and maturity take place will happen.
I mean, across our different businesses, especially our macro fund, I mean, we have in total about 30 different portfolio managers. And most of them, if not all, have had the majority of their experience working in Asia. They could be from outside of Asia, or they are Asians themselves. And we have almost, for all these 30 portfolio managers, we have not used a headhunter. Right? So I think hedge funds are about returns, and returns are about talent. And I think, and looking for the talent, I think it's a very active program where you have to go out there and cultivate. Many of the guys that we've known for, maybe we've tried to hire for, say, over 4 years before something changes in the large organization that they are in, which gives us that opportunity to hire them. So I think the talent is out there in Asia, except that right now, for this phase, it is still in the banks or maybe in the large hedge funds. But second and third generation is happening, and that's why we're sitting here. And as for the sovereign wealth funds, there is some amount of a crowding out because they manage it in-house, as opposed to, which is why the bulk of us have our investors largely from the US, right? Because the US, there's the pension system where there isn't really a sovereign wealth fund that crowds out, the hedge funds. So I think that Asia, over time, you will see more and more of the pension funds allocate more actively within Asia, and I'm optimistic that it will grow from where it is.
Okay. And yes, the gentleman in front.
Damian Brosnan from UBS. You've talked about different aspects in terms of domain expertise, core competency, natural domain with respect to the investment products that you manage. What about from a geographic perspective? Do you face more pressure from your investors to be increasingly global in your investment mandate or increasingly local in your investment mandate? And does that factor into what it means to be a great Asian hedge fund in this day and age?
Haider?
Sure. Yeah, I mean, we're a pan-Asian, but I think all of us are slightly different. I mean, Danny and Adam would describe themselves very differently than certainly I would. But we're a pan-Asia focused fund. When we launched, that's what we said. And frankly, if you look at my core expertise and my experience, it would all be in Asia, really, at least certainly for the last 15, 20 years. And so I think if I went to my investors and said I'm going global, I mean, I think there'd be a state of panic. And Manraj would be like, that's exactly what Manraj is warning us against not to do. So we are always going to be a pan-Asian fund, and that's our focus.
If I can just add to that, I think it's difficult to see that trend. I mean, around the table you have global macro investors, you have, as Haider says, Asian equity-focused investors. I think it's not a reflection of where you're located. If they happen to be in Asia and they have a clear domain expertise, as Adam says, in a particular area, be it macro, that's absolutely fine. But ensuring that as you grow in new areas, at worst, they should be adjacent areas. So I'll give you a couple of examples where we found managers who have been able to grow successfully, say in China. And this is, I think, unique to China. I wouldn't draw this across all markets, where they've been able to grow out of public equity into the private space, and then, given the size of the market, given the depth of the market in China, find sectors that they have very strong expertise in, and they see inefficiencies, and the industries are big enough that they can actually exploit those. I think, again, that's unique to China, and we could have another debate about how much growth we've seen in the last few years has reflected what's happened in the Chinese capital markets and what the future may or may not hold. So I would say it'd be pretty unusual for an investor in Asia, unless they already had an expertise, to go out and do something far away.
So I'm seeing signal that we're almost out of time, but maybe one last question. There was right.
Nick, my questions for you is, given that in the event-driven space it can be somewhat illiquid at times, do you have any view on, with all the growth of liquid alternatives, has that changed at all your view of liquidity, as far as position size, and have you discussed that with your partners at all?
So liquid alternatives into Asia event-driven, or?
Well, just the growth of liquid alternatives in general. I assume that to some degree that may then
find its, yeah.
Find to explain to you.
So we've seen very little impact of that in terms of, so I mean, I think if you look at a canonical event-driven trade, let's say an M&A trade, then in terms of entrance liquidity, there's a I think a linear relationship, probably linear relationship between sort of size and the number of people that invest in it, i.e. the US risk arb fund that's waiting for the big deal will invest a lot and quickly, and behaviorally, because there's probably a person sitting in Asia or maybe New York who's focused on that and only sees an opportunity once every 2 months, 3 months, there's a behavioral bias to favor it. Entrance liquidity can be affected very much by liquid alternatives, and those liquid alternatives are going to focus on those situations more in any case. Exit liquidity either comes clearly from the closing of the transaction, and that's the liquidity event itself, or the failure of the transaction, which is a liquidity event, which would then be exacerbated by the amount of capital in that. But I don't see that, in terms of measuring that, I've not yet seen liquid alternatives cause a dramatic impact. When you then look at things that go down the size spectrum or up the complexity spectrum, mandatory bids with interesting minority protection conditions that you might use, etc., where you're not playing for a spread, you're playing for a process, you're playing for the ability to influence the outcome or the ability to use the floor that's provided for you to have some optionality on an outcome, then it's the liquid alternative space finds it harder to invest in that. It's not here's a deal, it's been announced, we're going to put X amount of capital to work in a mechanical way. These situations don't admit of that. So in some ways, in the US, where deals all get sort of prosecuted in the same way, two-stage merger in Delaware, it's easy to mechanically do that. If it's, here's a Hong Kong company that's incorporated in China and it's got a bid from a Malaysian company and these are the rules, and there's a founder shareholder owns 60%, and now that kicks in this rule and that rule. It makes it very, very difficult to do that mechanically in an automated fashion. So in a lot of those situations, it's not just that we don't see liquid alternatives, we don't see very many other people doing them at all. Will that change? I doubt it in those situations, but here's a $5 billion deal in Australia or a $6 billion cash deal in Thailand or elsewhere, there will be incremental capital at play, but there always is, and it generally creates a too optimistic outcome of the spread.
Okay, well, I think time's up for us. I'm going to thank my panelists for their open sharing, and I'm sure all of them will be around and happy to take questions if you have any further ones. Thank you so much.
Thank you.